everyone, and welcome into crushthestreet.com. I got a great guest on the line, returning guest, someone who's going to give us some insight on what is going on in the economy, boots on the ground, just someone who really understands it. Wall Street Journal's Moneyball economist, #1 forecaster of jobless claims on Bloomberg, which of course was important with what we've seen happen with jobless claims going into this illness pandemic, and just kind of stringing things along with stimulus and all the trillions of dollars that have been thrown at the system. So I'm really interested in getting Andrew Zaitlin's opinion on what is going on in the economy. Andrew, thank you so much for coming on Crush the Street with me today.
Ken, you are awesome. Wow, what a great intro. Hello, everyone. Happy to be here. So what's new? What's happening in the world? Anything since we last talked?
Yeah, what a crazy world, huh? Just a lot of different sensations when it comes to freedoms, going outside, interacting with the world, traveling, watching a baseball game with no fans, and the world of golf, and just seeing how the world's reacted to this virus, this pandemic, is a very odd thing to me. I mean, we subscribe to so many things that I don't think I've ever would have imagined. But at the same time, there are people dying from it, and there's obviously a lot of scrutiny on that as well. But, it's one of those things. I would have never predicted this. Certainly the economy was going in a direction that I would have never imagined, but my goodness, we are in a crazy world.
Definitely. It's interesting. I was recently reading this article. It's kind of a testimony to a philanthropist who was around about 180 years ago. The guy's name is Moses Montefiore. And it talked about how he goes from England on boat, and this is the 1840s. It's, maritime travel's pretty accelerated at that point. And he goes through Turkey and down to Egypt and Israel and back. It took him 10 months. And it took him 10 months because there was a cholera epidemic sweeping the world at that time. And this whole thing was just writing, oh, what a great guy, philanthropy in a challenging time, kind of like love in the time of cholera, kind of Gabriel Garcia Marquez type of thing. But what was wild for me was every time it talked about, and then he stops at this city or that city, it was exactly like what we're experiencing now, this total lockdown, quarantine. They didn't know what cholera was, or they knew what it was, they just didn't know it was a bacteria. They didn't know how it was passed, but it was the same thing that we're doing, which is don't go outside, stay away from others, don't travel between cities and so forth. Keep it under wraps. And that's where we are. And we haven't seen that in a long time. And so coping with that, dealing with that, it's all really net new. This isn't like the Spanish flu in the 1969 era where you said, the Hong Kong flu. We said, okay, it's a flu. People are going to die. We have to continue to go about our business. Totally different. And when you look at the consequences of lockdown in today's economy, not just domestically, but internationally, this is going to be talked about for decades. How do we handle it? How could we handle it? The what ifs and so forth. And when you step back, a lot of people talk about the V. Is it going to be a V-shaped recovery or a W or a U? Pick your letter.
Liquidity recovery, L shape.
Mm-hmm. And that exactly. And that's really where we are, is everything's been turbocharged by that liquidity. And that was great, right? It prevented even more mass hysteria. It got us, I don't know if you remember early times. I looked at this and I didn't think lockdown. So I thought, okay, by the end of the summer, we'll be through this and a cure will be on its way. And, it will have the shape and form of a really bad aseasonal flu and we'll get through it. Then we get this lockdown and it's a throwback to the old days and the entire economy seized up. Okay, so we threw some money at it. I think we're about to re-enter. I'm more of a thoughtful person who looks at this as a W. The underlying economic fundamentals are bad, and they're going to get much worse than what we just experienced as we head into the fall. And then you look at the stock market, and it's like the stock market doesn't know that there's any economic hit. And then you look at gold. And isn't that the interesting thing, where gold is now, again, touching all-time highs, I think, $2,000. Bitcoin surging back above 10,000. I mean, these are all, to me, signs of a disconnect, of a bubble in the stock market. There may be a little bubble in gold and Bitcoin too, because when you throw $1 trillion and then you set up a promise to throw another $1 trillion into the market, and then EU kicks in $1 trillion, God knows what China's doing in the background. there's a lot of money sloshing around. And that's all that's doing, though, is just kind of refilling the bucket to almost where it was, almost. And so what happens when that runs down? What happens in December when this new load of payola runs out? And that's, I don't think the market's really thinking there yet.
Hmm. I tend to agree with you. And I think what many people were hoping for when we got into this recovery, this bounce off the March lows, which, by the way, coincided with the Google search term coronavirus, COVID-19. It all peaked right at the bottom, which is, so fascinating to me. And then everything started to come back.
That's so typical, right?
Well, and it really comes down to, I think, the hope that things were going to get better. But now going into July, you have all these, reported spikes and increase, and it's just not going away. So, I was speaking to actually a pastor who runs a mega church local to where I live, 15,000 members.
Wow.
During the pandemic, he was saying, the volunteers weren't that worried about it. They weren't that concerned. And the volunteers are the ones that are really exposed. They're shaking hands with people. They're teaching the classes, and the pastor, there. He's like up on stage. He doesn't interact with people. Anyways, he's like, but this second wave coming around, that's scaring people. That's scaring the volunteers now that, hey, I don't want to, this hasn't gone away. It's still here, and I want to take this more seriously than I did in April. And so just from a confidence perspective, in a representation of a church setting, it's concerning people, right? And I think that's happening in the rest of the economy. And that's also a problem for just, what we're going to face, the fallout going forward.
Can I throw some data? Let's start with you're a mechanic, and so you would appreciate the data. Let's build a foundation for the dialogue a little bit. I am a huge labor guy. I look at labor as it's the oil that keeps the economy running. It's if you're going too fast, if you're going too slow, it always shows up in hiring. So one of the things that I do is I collect and look at local boards, local job postings. Why? Because these are the mom and pop type of entities, the dry cleaners, the local restaurants. They're not the big companies which have money in the pocket and won't, then also they can hire and fire at will. Now, what you see is two things that I think are worth starting with. One is wherever lockdown stopped, I'm going to call it lockdown. Shelter in place is such a gentle term. It's lockdown. Wherever lockdown stopped, job postings soared. I mean, literally within 10% of where they were last year, meaning the real boundary to an economic recovery is lockdown. Are you forcing stores, restaurants, and people to not conduct business, to not go out? And where it's underway, like in Honolulu, you can't not go to Hawaii, where it's underway in San Francisco. These are cities where the level of hiring is 50 to 60% below where it was last year. You go to Florida, Tampa, places like that, it's 10% below. So right off the bat, you have a constraint, not coming from the consumer side, just coming from regulations. You remove that regulation, you remove that restriction, everyone's out. There's a pent-up demand is my point. Then when you look at the job types, it follows. Jobs where HR jobs, for example, are the worst performing jobs. No one's recruiting, no one's hiring. Bars, restaurants, the same thing. And you're talking 60 to 70% below where they were last year. All right, so the fact is the economy can immediately get back to business if two things happen. One, you allow it to, you take off the lockdown, but then you have the consumer willing to go out. And this gets back to what you were saying. Are consumers ready, or is there still some anxiety, and are they hesitant? And I think that depending on where you are, there's more or less willingness to go out. Now, let's talk financials. So we've got the human condition. Everyone's stir crazy after 4 months of being, kind of locked up. You got some cabin fever. The financials are also really positive for consumers to spend. You've got a rising pent-up demand. Nobody went on spring vacation. Almost nobody's going on summer vacation. Last year, $250 billion was spent on overseas travel by Americans. Okay, Some of that's business, some of that's personal. None of that's getting spent. That's all staying here, domestic spending. Disposable income soared in the last 2 months, just soared. And a lot of that's because the government dumped money out there. But my point is, you have people spending a lot less. You have money being thrown at them. This economy is just the economics of going out and coming back to life are positive until we get to a second wave. If people don't feel good about going out, restaurants aren't going to come back in, travel's not going to come back in. You've got some major sectors out there in the economy that won't quite recover in the near term. But then you have others that are recovering. Construction, I mean, home building and buying is surging because rates are super low. People are thinking, hey, now that I can work remotely, why live in the city? I'll live outside the city. I get more land. Now that I've been stuck at home for 4 months, I'm looking at my little postage stamp size backyard and thinking, wow, my friends who pulled up stakes from San Francisco area moved to Charlotte. Were almost able to pay cash for this palatial house. They're laughing at me. Everyone leaving California is laughing at me. I think you're going to see a demographic shift, but in the next few months, you have conditions, in a sense, positive for now, but then they're going to weaken again. I mean, we've got school starting, and this is the scary thing that I look at. So what I'm saying right now is it was really bad. It's recovered a lot. We're not there yet. It's not full. It's not going to recover at least for a year or two. Even if you go into, for example, restaurants into this phased lockdown where social distancing. Hey, a restaurant 6 feet apart, that's what, 25% capacity, maybe 50% capacity. Now we've got worries, like you said, spiking COVID again. Hey, people are hesitant to go out. It gets back to, I've got the money to spend. I just maybe won't spend it in the same way, in that leisure, interactive, social way. Certainly won't travel. I don't want to be in a tube where the air is getting recycled. These are kind of real economic impacts, but the money's there and it's growing. The less people are going out, the less we're doing our typical consumer spending, the more it's there. So I would imagine December, January is going to be interesting. But we're coming into a real weird area. You mentioned, for example, people who have been interacting physically and close to others, thinking, and we were playing kind of a game of chicken. I don't want to say chicken, but the goal was, let's go back to March. The goal was, hey, we don't know if this is bubonic plague coming at us. Let's be careful. Let's really be careful. And what that means is we're not going to interact physically as much as possible. And we're hoping for two things. We know this is going to spread through us like wildfire. There's no way to stop this. What we hope is to control it a little bit, delay as much as possible. Remember that, flatten the curve, not stop it. You can't stop this. It's going to happen. But what you can do is at least delay the moment of reckoning such that, but maybe a vaccine will come out or treatments will come out. And that's what we saw as months passed. Wait a second, there's this treatment. Hey, you know what? Maybe you get to the hospital before you're sitting there 7 days with a fever and coughing. We had treatments and hopefully the combination of vaccines. So all of a sudden you realize, okay, are we at that point now where we feel that yes, and you saw this in Florida when they opened up and all the young people go out, it's like, hey, you know what? I may not be impervious, but I feel comfortable that if I do get it, I'm not going to die from it. I think we're going to see a shift in that. Now you've got, and I think the latest earnings releases like Delta Airlines and Southwest Airlines, they said, 30 days ago, I felt more confident. Now I don't. People are starting to pull back because there is that anxiety. Here's my main concern, Ken. Okay. Take those two things. Concern over COVID combined with a lot of money. Pent-up demand, we're consumers, we'll spend it. And as you can see with Amazon, people are finding ways to spend. The challenge I see, though, is when we come into school season. Back in March, you had 2.5 months of remote learning. And everyone, I think the mood back in March was, we're all in this together. There was almost a positivity. We don't know what's going on, but look, let's work together. I think as we've gone along, I think some of that positivity is no longer there. And I think we're going to go back into, again, kids during summertime doing whatever they're doing. But when we get back into a school zone, remember, there has to be a parent present. 50 million households in America have kids that are under the age of 18, and they're going to be going back into school, and they're going to be doing it from home. This isn't 2.5 months. This is 4 months or more. one of the parents needs to stay home. So now we've got an unemployment problem revisited. Okay, got a stimulus bill coming out today, Friday, whenever, another trillion. Is that going to cover 4 months? And let's say it does, but you've got a different mood. I think people are grumpy. They've got cabin fever. They're going stir crazy. We've been locked up 4 going into 5 months now. Now you're telling me another 4 months. My kids are around all day long. Teachers clearly aren't paid enough. I think at the end of the day, we're all going to look back and go, oh my God, I need to give teachers more money. I couldn't do this on a daily basis. But the point is, you're going to take out 50 million households. I don't care how you want to figure it out and balance the load. Mom's home Monday, dad's home Tuesday. But not every parent can remote work. Doctors cannot remote work. So we are looking at another massive hit to the economy. Let's say the $1 trillion comes in, it covers that damage. Okay, $1 trillion got us to this point, 3-4 months. All right, let's say $1 trillion gets us limping along until the next wave, until January. What happens in January? Everyone's tapped out. Do we throw another $1 trillion? I mean, how long do we keep doing this? And meanwhile, the rest of the world, the US is an exporting economy. We're not China, but we are an exporting economy. And the challenge here is the rest of the world can't print money to cover their economies. You have a major collapse in trade going on. Germany hates to put money out there, credit. They had to support the EU in putting almost $1 trillion out there because they're now looking at a recession that's worse than the 2007, 8, 9 period. So I'm looking at this going, hey, right now, again, it's like nitrous in the tank. All right, we'll keep going. January is when things suddenly become a problem.
Andrew, totally agree with you on many of the things you said. Now, I kind of wanted to get some further clarity on what you mentioned about San Francisco and Florida, the hiring. Now, it's interesting. I don't know what the numbers are for the amount of jobs there were in San Francisco and some of the cities in Florida. But if, let's say, they lose a lot of nominal jobs, and what did you mean by hiring is down 50%? So
okay,
and let me clarify, because like you may sound like, oh, Florida is just 10% is 10% below.
I threw out numbers,
but if we're way below where we were, the problem is backfilling everything that was lost, right? You know what I'm saying? Like, just because we're 10% up, do we? Is the demand in the economy even there to get back to where we were? Is that what you meant? So anyways,
let me contextualize. Yeah, let me contextualize. So if you follow payroll data, with every month they release, this is where we are with payrolls. And there's some fudging of data, and there's always, whatever, but it's what we have. 70% of all job losses. Remember, we lost at one point, 25 million jobs went away. I'm not laughing. I'm just like, wow. But the pie, 70% of those jobs really came down to 4 things. 20 million jobs were lost, of which 5 million were restaurants and recreation, because they couldn't. Hey, casinos, you are shutting down. You have no choice. Okay, so that's a big chunk. Then you had retail, same thing. You're not allowed to be open. Then you had professional services, meaning temp workers. Hey, if you're an office, you're shut down. You don't need that clerical worker. So shut down translated immediately into these jobs are not going to be here. We've come back a little bit, and we've clawed back a lot of those jobs. Again, it's one-to-one. If you let me open my store, I will get customer foot traffic. I will hire people to help. It's just that straightforward. Well, I don't need the same number yet because, again, this is baby stepping. There's a lot of cautious optimism among consumers. And depending on where you go, if you go to Costco, they're back in business. I don't think they ever dropped. There's some destination retail stores, the essential stores. So what I look at is I say, look, we lost this big chunk. There's an upper limit to how much is going to be recovered. Again, go back to if you've got social distancing, you can't sit at a table that's closer than 6 feet from somebody. You've knocked out easily half the capacity of a restaurant, which means I only need half my workers, roughly speaking, right? So you have these constraints that are going to keep us from fully recovering. I split this into 2 things. I split it into the hourly workers who are working at counters or in restaurants, and the more professional workers. I see a wave of the professional workers getting hit. That's coming in now. I see the Googles of the world, I see all the banks of the world saying, you know what, we were able to go for a couple months because we thought we wouldn't need to fire people. But it's been a couple months, business is not rebounding. I need to do some trimming. I need to right size. I don't need as many customer facing people because I don't have as many customers, and on and on and on. So it's going to be a while to recover. The data that I was referencing is my own data. I cover 48 cities in the US. I cover roughly, let's say, over the course of a month, it's going to pull roughly 600,000 job postings over the month. So it's broad, it's deep. It's more information than you're going to get out there from conventional. But it's even better because it's dealing with these mom and pop stores and businesses, and they don't have the credit lines that most companies have. So anything that they're doing job postings wise is going to reflect the immediate situation, finger on the pulse. And that's why I'm number one for jobless claims and why I do this, because this really is the unmolested, unmanipulated data. This is really what's going on in the economy right now. And we know historically what happens when things go up and down in jobless claims. So fast forward. Every city is a little different in terms of the total number of hiring. San Francisco is going to have a bigger demographic, bigger population size. They're going to have more job postings than, say, Tempe, Arizona, right? So I don't look at it at the number level. I look at it year over year. Hey, last year, San Francisco, you needed this many people. Where are you at this year? And that way, it normalizes and keeps the data consistent across everybody. What I found was by April, the first week of April, the number of job postings that any given city needed compared to the same period last year. So that takes out the seasonality. Oh, it's July 4th weekend. It went down to minus 80%, which means there was no hiring. And it was across the board. Then by the time we got to May, and you had some cities and some states relax the shelter in place rules, you started to see different rates of acceleration. Still negative, nowhere near last year's level of job postings, but some were less bad. And it's that less bad type of experience that's interesting. The degree to which Arizona and Florida recovered their job postings was breathtaking. They went from minus 70% to minus 10%. So if last year, just to throw a fake number, what that means is if Tampa was looking at hiring, say in a given month, 10,000 people last year, this year, closer to 9,000. San Francisco, let's say they were looking at hiring 100,000 last year, this year, 45,000. So this is the heart of the challenge. The major cities in America drive the absolute numbers, and they're still on lockdown. New York, San Francisco, Chicago. These are all Honolulu. These are all cities, large population, and they're on lockdown. You go outside the major cities, life is a lot better in the sense of businesses have bounced back. So those are the numbers I'm citing. I collect what local businesses are doing and say, hey, where were you last year versus this year? And what they're saying, and one more interesting thing is when you look at the job types, security jobs are the only job that didn't really get affected throughout this. Case in point, I went out to Target to go shopping and get my essentials back in April. Took my daughter. Big suburban shopping center, as you can imagine. Target's one of the anchor businesses. You've got 20 stores, big parking lot. Home Depot down at the other end. All right, everyone's at Target. It's the only store that's open, and everyone's trying to get those critical supplies. At the other end of the shopping center is one car, and it's a police car. And my daughter asked me, she said, why is the police car over there? We've been seeing fights break out on the news at Targets where everyone's scrambling for toilet paper. Shouldn't that officer be over here where the people are to protect us? I said, no, he's not here to protect the people. He's here to protect the businesses. You've got 20 stores that are unmanned, that are targets for someone to break in. That police officer is sitting there to make sure no one is going to break in because unfortunately, these businesses are a core part of the local economy. And at that time, also, there was no security. There's no rioting. There was no protesting. And so they kind of had in fact, crime rates went down at a lot of times because people were home. You didn't have break-ins. People were home. And so the police officers had the ability to go out and protect businesses.
Andrew, let's talk, and so you're alluding to this, and I just kind of wanted to get where you think we are on the spectrum of, Trump optimism, things coming back, best third quarter, 2021, we're recovering in a great way, to the Peter Schiff spectrum of the
Right.
analysis, where this is the biggest bubble in history, and it's going to be the greatest crisis. It's going to take 10 years to recover from this if they don't continue to inflate and kick the can down the road, type of thing. I mean, what's your thoughts on that? I mean, I know you talked about the W. If there is there any way to articulate more where you are on the spectrum of bubble versus recovery versus
I think
problems
I
in the
think they're
economy?
both right. I think they're both right. Peter Schiff is a one note guy. I mean, he's been saying this is a bubble since what, 2000. I mean,
Right.
he's not wrong. He's not wrong. I mean, when you're talking about almost 0% interest rates again and keeping things going, he is absolutely right. This is bubblicious.
Well, and they've taken it to the nth degree now. There was $1 trillion of stimulus in '08, and now we're like 7 times that between monetary and fiscal, and they're talking about more. So I mean, they're continuing to add more fuel to the fire every time we deal with a crisis.
So big picture and long term, near term. Long term, Peter Schiff is right. When does a bubble pop? History tells us eventually it pops. Right? You can only debase the currency for so long. Is that a century? Is that 2 centuries? Is that 50 years? Hey, we're barely 20 years into this puppy, right? Ben Bernanke helicopter spending. In the short term, Trump is right too. Oh, it's a great economy. It's fun with numbers. The reality is we have people out of work, but they've been given money. So if you look at disposable income, it was up 15% in April. It was up 9% year over year in May. Okay, you're talking about a figure that barely moves 1 or 2 or 3% year over year. So much money was thrown in. I mean, it's just mind-boggling. And ultimately, that gets drawn down because, again, a lot of the people who got it, they've got to pay rent, they've got to eat. It's being used. It's not just sitting there in the bank. But you take that and you take the costs of that you're not spending. Where does the economy go? Is this something that's about to implode? Is it fantastic? It's election year. It's election season. So you're going to have this, Schrodinger's cat. Is it dead or alive? Yes. Yes, it is dead and alive. I look at it more of we have a very resilient economy. We have a very robust economy. We have something that the rest of the world doesn't have, which is respect for intellectual property and civil rights. That means if you want to maximize your inventions, you want to maximize your investment, you do it here safer. You can't do it in China. EU, there has been economy at this point. They're just limping along. They're not growing. The only reason they're growing is because of other things we can talk about another time. We are the economy in the world. If you want to talk bubble, you talk China. Their housing bubble is mind-boggling. I mean, it's just, we put all of our money into the stock market. The Chinese put all their money into the housing market, and their bubble is just ridiculously huge relative to ours. Is there going to be an end to this? No, they won't end it. No. There's no way that they will stop it because look at the result. I throw $1 trillion at a stock market. Now, you and I and everybody out there knows this economy is handicapped right now. It's limping along. You cannot have an economy that had 20 to 25 million people out of work, may have recovered to having only 10 million people out of work. You can't tell me that this is a strong economy, and yet the stock market is back to where it was. Come on. That's all just liquidity talking. And there is a little bit of that false hope and confidence. That's going to run out. I
100%.
I mean, we have a huge disconnect between the fundamentals and the stock market. And that's just, it's not, people don't sit there and scratch their head and go, gee, how's that possible? Well, you put $1 trillion into the economy overnight and watch what happens. People can spend. I mean, Domino's Pizza had a great quarter. I ordered my pizzas, that kind of thing. They had a great quarter. There were winners, there were losers. When you look at the aggregate, high level, our economy kept moving forward, but it's moving forward on borrowed money. When Vito comes to me and he wants his money back, What am I going to do? Hey, Don Trump, he put $1 trillion in there. He's going to put another $1 trillion in there. At some point, you pay the piper. And this is where shift goes. What we've been experiencing, though, is nobody's ever paid the piper. The government keeps throwing money out there, and there's no market. You know, the traditional market would say, hey, you have to reduce your debt. Remember, Reagan was the first one to really look at deficit spending and say, what difference does it make what the government does for spending? And he broke through that. That was under Reagan. So remember the balancing the budget discussions in the 70s and the 80s? We got to balance the budget. Have you heard anybody? I mean, the Democrats are out there saying $1 trillion. Hell, man, let's make it $3 trillion. Why are you being so cheap? There's no such thing as balancing the budget. That's what the market is supposed to do. You know, your bonds are supposed to reflect. I mean, our interest rate should be at 10% right now. You know, we're printing money. We should be Turkey at this point, where our rates should be just, ridiculously, reflecting. Although Turkey's a bad example, maybe, just because they control the lira so well. But you get the idea. The global market would respond normally to what we're doing by throwing up all over our bonds, and they're not. And this is what's interesting. One more thing to consider. You're an investor, all right, and you've got money. You're trying to figure out, where do I put this? Do I put it in the stock market? Just to let people know, I got out of the stock market a couple of weeks ago. I'm sorry, but I cannot I don't see the upside anymore. What, we're going to go to 3,500? Okay, but then what? I got out. I said, I can't do this anymore. I got lucky in the sense, I got out of Amazon when it was raging, things like that. But I'm out. So let me talk in terms of, I'm out of the market. I've got cash on the sidelines. I want to put it to work. I could go into the market. Let's face it, I might do that. I might buy some futures on the S&P, because when you throw another $1 trillion at the market, it's probably going to go up more than it's going to go down. Do I do gold? Well, yeah, gold is saying basically the currency is going to be debased. It's no wonder that the dollar is going down. The currency is going to be debased. At times like this, with low interest rates, you put it into an asset like gold, real estate maybe. But I sit there and I think, okay, one thing I'd like to talk about that nobody talks about is Muni Bonds. This is crazy. Every city is about to go bankrupt in America. The tax revenues are horrible, and they're not going to get better. One of the reasons, the prime reason the Democrats want to throw another $2 trillion is they want to give all the cities and states money to cover their problems. Chicago, you name it. The overspending, the pension promises. This is the moment of reckoning. Every city is now bankrupt. Don't kid yourself. There is going to be only one direction for every city. They have to somehow get revenues. Now, do you think there's going to be higher taxes? Oh, yeah. Oh, yeah. California has Prop 13, which says you cannot raise the tax on my property. You cannot. Well, guess what? They're voting on ditching that. Why? You own property here? Screw you. What are you going to do? Move? No. So I'm going to charge you another percent. You're going to pay me another couple of grand. Taxes are going to go up in every city. There's another place they could go, though. And I don't mean just also cut services. Muni bonds with rates so ridiculously low, it's less painful to put a bond out there. You're going to see a flood of muni bonds, because again, a lot of people in the old days, you could tax people, they couldn't move. You couldn't move overnight. Today, with remote work, you have people like my friend who says, you know what, I can do my job in a city where, okay, the San Francisco education's terrible. I mean, it's nationally, California's education system is, I think, 48 out of 50 states. It's horrible. For the amount of income tax and property tax people pay here, this is blasphemous. He's like, you know what? I can spend half the money, do my job, keep more of my income living somewhere else, and it's remote work, so my boss doesn't care. Facebook is pursuing this, for example. They're now saying, tell you what, if I need somebody to do this job and I can hire them in Boise, I'm going to pay the Boise price. I'm not going to pay the San Francisco price, which is probably double. Everyone's upset by that, right? You should pay the price. Well, the reality is this is very deflationary. If you're now in San Francisco and you're trying to get hired, the boss can say, I got a guy out in Boise who can do this. You can move to Boise. I'll pay you. Cost of living's a lot lower. It's a good trade-off. You're now going to see in a lot of major cities a demographic shift over the next year. I don't mean months. I don't mean years. I mean within a year. people are going to see what happens in January and say, oh my God, I don't have a lot of money. You're going to see cities say, I'm cutting services, I'm taxing you more. You're going to see home buying at an interesting place because Airbnb's collapse is going to pick up pace. Airbnb, I know a lot of people who own a lot of properties that are vacant, and they are paycheck to paycheck. So you're going to have a lot of properties hit the market. You have a lot more headwinds and bad news picking up in January. So I sit there with my money and I think, okay, I want it extremely liquid. Muni bonds are going to be coming out. I think that's actually going to be interesting. I don't know how to play that, but I suspect between now and coming up, there's going to be a flood. Probably, if I had to fat finger it, somewhere around $50 billion to $100 billion plus of new muni bonds, just to cover the situation, as well as higher taxes. None of this is good for the economy. We have nothing positive. We have a little bit of a recovery bounce. We have a little bit of money out there. So I would put my money into gold and a couple of other, when you have an economic seizure, and that's what we have. We have an economic seizure that's been delayed. It hasn't been addressed. I think that the piper gets paid in the spring. And so you kind of plan for really bad news picking up in the first quarter.
Andrew, let's talk about gold and silver and Bitcoin here as we close out this interview. Silver had the best week in 40 years.
I know, man. I'm a silver bug.
I love it.
own silver, man. How did that happen?
We're really starting to see it play out the way, all this economic news that we've been talking about is really start to reflect. And I'm very happy about that. Gold led the way. And then as the capital is starting to flow out to the margins, there's more conviction in what is going on in precious metals. We are seeing silver start to react as well. And so what are your thoughts on this? Talk to us about the metals. Talk to us about crypto. And is it all tied to what is going on with the money printing and concerns in the economy?
You've got a lot of things that are positive for gold, for silver. I mean, the ratio between gold and silver was out of whack anyway. It's, if we go back to the Great Recession, I think silver touched, was it $40? I mean,
close to 50, right?
Was it? I mean,
well,
but when you get
2011,
what you have is the market saying the good times aren't there, the bad times are coming. Let's put our money into precious metals. That's the message. And why now? What's happening? Well, I think another trigger is China and Hong Kong. You basically have Hong Kong going away as a capital center of Asia. And you have a lot of wealthy people in Hong Kong and elsewhere who are saying, I need to get my money out. I need to get it out now. Bitcoin was a major means 2 years ago of getting your money out of China. It was. It is today. So I would suggest that there are several multiplying converging waves. One of them is China. Capital outflow is huge. It's just going to get bigger. Again, Hong Kong was the trigger. Everyone saw the writing on the wall. The U.S. has basically said a few things. We're at war with China. Look, there's no other way to put it. We are at war with China, an economic war, and it's full blown. This is not Russia, where there's a weak economy but a strong military. This is China. They are very much a house of cards. They are an economic powerhouse who we are at war with. We do not want them to continue to be economically strong and do the things they're doing. Okay, right or wrong, that is the reality. And you're starting to see this in many ways. You had the closing of the consulate in Houston, the allegation that that was just a spy center to collect intellectual property. You have another one, which is there are cables, fiber optic cables being laid between the US and Asia. And fiber optic cables are necessary for the internet and communication. Well, they were being routed to, and we're talking the Google, Facebooks of the world using this cabling system. They were being routed through Hong Kong on their way to the rest of that part of the world. And the fear, very real fear, was, well, once they're in Hong Kong proper, they're in China. And, well, spying happens. And so now there's pressure. Again, this is economic as well as national security. Taking away major data center and communication hubs is meaningful. So what you're seeing is an economic war, and wealthy Chinese are responding accordingly. They understand what's coming. They understand confiscation of property. They understand being executed for corruption. They understand they need to get out and get their money out. This is partly why Britain, the UK, recently said, hey, if you live in Hong Kong and you've got the money, come on by. You now can be a member of the United Kingdom. Okay, it's just you take your money and come on over. Well, how do you get that money out? Do you sell your property? What do you do? Buy diamonds? No, diamonds aren't real. Diamonds are hard to sell. Gold is very easy to sell. And so that's what you're seeing. I think that's on one side. Then you've got the classic inflationary expectation. If you keep throwing money at where we are, eventually you've got inflation. And we did. I mean, that's what the past few months were. We inflated our way out of a bad place. We're about to head into another bad. I mean, I didn't mean to be doom and gloom. I'm just saying, hey, reality check. We're not out and we're about to fall back in. It's kind of like if you're whitewater rafting. We just passed one of the rapids. Oh, wait, there's another one coming up. And so that's where we're heading. Okay, we'll inflate our way out of there. In the meantime, we're debasing the currency. We're doing all these things. Interest rates are at zero. Gold seems the place to be. Nobody can argue with being in gold right now. The valuation of Apple, you see people sitting there yelling, is it worth this? Is it worth that? Tesla, what the hell's going on there? Nobody can tell me there isn't market manipulation with Tesla. It is not worth what it's there. And so people sit there and say, well, there's always gold. So I think that's what we're seeing. I think we're not at the end. We're not at the beginning. And there's still upside. I think it will continue to rapidly. Again, you throw $1 trillion out there over the next month, gold hitting 2,200. You've got FOMO, fear of missing out. All these things play into it. And I got lucky. I actually happened to own some silver, like actual silver, but I have silver actually sitting here, not a lot, certainly not tons like you do, Ken.
Andrew, do you, and this is just the last bit here, as we wrap up, do you believe with that FOMO, with all-time highs now in the cards, are we going to see a wall of money start to enter the space, which takes gold much higher than, maybe some conventional person might consider reasonable?
Yeah, I think the analog is 2008, 2009. Economically, we are in a worse place. We have more people out of work. I mean, you can just say this is what happened then. Back then, they didn't quite throw as much money out as rapidly. Okay, we're still in the same place. Economically, we are going to be in the same condition today in January. Economically, we are toast. We are in a bad place. So I look at this and think gold. And money's got to go somewhere. And if the stock market bubbles up even more, you just know it's going to pop. And man, that popping is going to be horrible. And then you got another wave, everyone's 401ks. And now you've got the question of who's president. If Trump is president, you probably will see something real happen, an infrastructure bill, something real. If Biden is president, I think all bets are off. I don't think, and let's face it, and I'm going to get political here, everybody knows that Biden's going to be a one-term president if he's elected. Okay, he's 77, showing a little bit of signs of trouble. 81, you're going to vote for him again? No, you're really voting for his vice president right now. And so a one-term president, he's not going to really be able to put anything forward. The economy is toast. Democrats like to tax. You go down your laundry list. I don't see a lot that any president, Trump or Biden, could put on the table that will save the economy in January. An infrastructure bill would take a year to play out.
All right, Andrew. Well, thank you so much for your time coming on Crush the Street and, carving out this amount of time for us here. It's super appreciative, very much appreciative. And I, hope to have you back on in short order here and kind of give some different perspective on, what you see going on, how you see the employment. I thought that was really interesting and insightful in terms of what we're going to expect going forward here and everything else that you gave us. So thank you so much. If people want to learn more about the work you do, where can they go and what can they expect to find?
Well, we went private. We were out there for a while. We went private, only working with funds. But feel free to look for me on LinkedIn. Message me at southbayresearch.com. I'm there. If you need to
All right.
contact me, feel free to reach out. Take care, Ken. Thanks for having me. Look forward to connecting again.